Good evening, everybody. My name is Alice Simon. It's my privilege to host you this evening on behalf of the Economics Department and the Walter Matthau Center for Economics, Business, and Entrepreneurship. It is my pleasure to welcome students, hello, and faculty and members of the Delaware and Columbus community, as well as the Ohio Wesleyan community. And for those people at home who are watching us on web stream, hello. It is my pleasure to introduce at this time the newest member of the Ohio Wesleyan family. We have a new Dean of Academic Affairs, Martin Eisenberg, and he is going to offer some words of welcome. I'd like to share with you that Dr. Eisenberg has a PhD in economics. His areas are labor economics and economic history, and so it's most appropriate that he be here this evening representing the administration as well as the economic community. So please help me welcome our newest member, Marty Eisenberg.
Well, I'm delighted to be here, and let me also welcome you. It's kind of nice to join back into something dealing with something that is a great interest of mine, coming back to the world of economics. I don't get to deal with a lot of economic questions in a direct way in my role as an administrator, but it also reminds me of one of the challenges of being an economist is whenever you say to the world that you're an economist, people will always ask you to make predictions. Hence, if you notice, one of my fields is economic history. And one of the great things about being an economic historian is you don't have to make predictions. So you're guaranteed that one of the challenges of economic forecasting is always the question of how do you do it and always be right. So I advise you as you listen to these forecasts to listen for the important things like do they actually tell you timelines? Do they actually have units involved in their forecasts? Having said that, only to put the pressure on them, because it's very easy to make forecasts when you don't have timelines on your axes and you're very imprecise. It's hard to be wrong then. But my role is actually to also introduce our moderator this evening, which is Dr. Goran Skobels.
Good evening. I always love this conference. It gets local community together, students, and we always get three very distinguished speakers that we have tonight. The game plan is going to be each one of them is going to present for about 10-12 minutes, and then we're going to try to have a little interchange between the three of them, and then we'll open the floor to questions. So we have, as always, three distinguished economists with us. Starting from the left, we have Ian Sheldon, who is the Anderson's Professor of International Trade and Graduate Studies Leader for the Department of Agricultural, Environmental, and Development Economics at Ohio State University. His research interests involve international trade and policy, and he earned his doctorate in economics from the University of Salford in the United Kingdom. He's going to be giving us an international perspective. On his right, in the middle, is Ed Notek from the Cleveland Federal Reserve Bank. He leads the development of the bank's forecasting models. He joined the Cleveland Fed about a year ago, and prior to that, he worked at the Kansas City Federal Reserve. In addition to forecasting, he does a lot of research on consumer debt dynamics and firms' price-setting behavior, etc. And he earned his doctorate in economics from the University of Michigan. And on the far right is Jim Newton, who is the president and owner of Central Ohio-based Economics Perspectives Incorporated, and he previously served as chief economic advisor for Commerce National Bank in Columbus and taught economics at Ohio State University and DeVry University. He earned his doctorate in economics from Ohio State. So we're going to go international, followed by national perspective, followed by a local perspective. All right, Ian Sheldon.
Oh, take screen.
There it is.
Okay, you can never trust a bunch of economists to get the equipment working, right? We normally assume it's working okay, right? Thanks very much for inviting me here again. I came up here a couple of years ago and I guess I didn't completely embarrass myself, so that's why they invited me back again. I'm going to give a global economic outlook. We have a very short amount of time, so I'll whip through this pretty quickly, and hopefully this will generate some interaction between us guys and also with you as the audience. Whenever I do any forecasting, there has to be some truth in advertising. I'm not an economic forecaster, but I pay a lot of attention to what's going on in the global economy, and typically for this kind of talk, I would use something like the IMF, the International Monetary Fund's World Economic Outlook as the basis for what I have to say, and maybe my colleague from the Fed also pays attention to what the IMF has to say. And there's a couple of things I might be able to set you up for when we talk about quantitative easing. I'm assuming you're going to say something about that in your presentation. So what I'm going to do is talk, first of all, about where we are on global growth. Then I'll say something about inflation pressures as they're being seen around the world. Say a little bit about international trade and, more importantly, global economic imbalances, which is something we've been talking about for about the last 10 years, and we still don't seem to have resolved this problem of global economic imbalances, particularly the fact that a developed economy like the US is still running such a large trade deficit, and an emerging economy like China is still running a very large trade surplus, and that's something that still concerns most macroeconomists. And then finally, I'll say something about what I think the important policy challenges are around some of the major economies worldwide. And then later on, if it comes up in discussion, I did bring a slide because I see my colleague Doug Southgate's in the audience, and no doubt he'll want to talk about debt to GDP or something like that. So I put a slide together just for you, Doug. Well, I have to preempt you asking me later, and I didn't have the slide. Seem to be having a problem getting... Oh, there we go. So let me start off by saying something about global economic growth. World output then is forecast to grow by about 3.6% in 2014, and in response to the dean who came up earlier, there's my number and there's my date, and it's a pretty short-term forecast. So I think I've met your criterion for a talk about economic forecasting. Now, what's interesting about where we are right now in the global economy is that if you think back to the immediate period in the post-financial, after the financial crisis broke in 2008, what happened then, it was pretty much the emerging economies, China in particular, that picked up the slack globally. But where we are now is that, in fact, it's the advanced economies that have gained a little bit more speed economically, and it's actually the emerging economies and the developing economies that have slowed down a little bit. But having said that, even if the US is going to account for a considerable part of economic growth in 2014 and maybe just a little bit beyond that, the emerging and developing economies are still accounting for the bulk of global economic growth. In 2014, they're forecast to grow as a group at about 5.1%, 5%, and that compares to the advanced economies, which are forecast as a group to grow at about 2%. Now, the important thing to understand is within each of these groups, be they the advanced economies or the emerging and developing economies, there's quite a lot of differences in terms of the growth paths within both the advanced economy group and the emerging economy group, and a lot of this depends upon idiosyncratic factors in those economies, but also at what point those individual economies are in their business cycle. So here's a first graphic. No doubt the dean would say this would meet his requirement of a good piece of forecasting. You've got some data that, as a historian, you can look back on. You've got a couple of years you can look back, and you've got about a year and a half's forecast in there. So on the left-hand side, you have actual growth into 2013 in the advanced economies, and you can see the big decline there because in the post-financial crisis era, and you can see growth picking up there, so that we have this here on the, let's see if the pointer works. Yeah, I guess it just about works. Here's that 2% that's being forecast here. This was the April IMF forecast here. There's been a little bit of a reduction here. So about 2% growth is being forecast in 2014. And then over here, the emerging economies, you can see the original forecast in 2014 had them growing a little bit faster, but that rate of growth has been downgraded by the IMF in their current report. So if you look up there on the right-hand side, that's where you get that, the dot's not coming out too well there, and there's that 5.6% that's being forecast for the emerging market and developing market economies. So let's talk a little bit about the growth dynamics in different parts of the world on the advanced economy side and on the emerging and developing economy side. As I mentioned a few minutes ago, the main boost to global growth is actually going to come from the US. Next year, the forecast is for about 2.5% economic growth. But as you would expect, given what's been happening over the past 3 months, 4 months, a certain amount of this depends on whether the US Congress achieves any resolution over the fiscal sequestration and whether we have an orderly management of the fiscal position that the US is in right now, or whether we continue with the mandated sequestration, which in some sense is not an orderly way of dealing with the budget deficit issues we have here in the US. And also, of course, this thorny problem of how to resolve the debt ceiling. As you know, Congress and the President simply punted this a little bit farther down the field for resolution sometime in the next month, I guess, month and a half. And I'm not entirely convinced, despite what the credit rating agencies are threatening to do, whether we're going to get any resolution to the debt ceiling question. So in the US, growth is very much dependent upon that uncertainty, I think. If we look to Japan, as many of you know, Japan has been conducting what the IMF jokingly calls Abenomics, named after the Japanese Prime Minister. Their growth is actually expected to slow down in 2014 as they start to unwind their stimulus package. That stimulus package, as I'll talk about later, included unusual monetary policy, the fiscal stimulus, and also structural reforms in the Japanese economy. And the IMF concludes that that policy has actually added an additional 1% to Japan's economic growth this past year. In the euro area, I'm from the UK, so I'm not from the euro area, but speaking as a European, and that's sort of what I talked about 2 years ago, was the debt crisis in Europe. The euro area, it's not quite the eurosclerosis that we had in the 1980s, but 1% economic growth is pretty unspectacular, but maybe not surprising given that the problems that we've had in the periphery of the euro area, particularly Greece, Italy, Spain, and so on. As you know, Spain has tremendously high unemployment rates. I think 1 in 4 people is unemployed right now. So even though growth is recovering or stabilizing in the periphery, there's still a huge amount of consumer uncertainty, debt problems, and so on. And there's a little bit of recovery going on in the core economies. That would be Germany, France, the Netherlands, and so on. In terms of China, as you know, I mean, it's sort of odd to say, and China has a lower growth forecast, and we're talking about a forecasted growth rate of 7.3% next year. But remember, China, the Communist Party is figuring out how to retarget Chinese economic growth to more of a sustainable growth path, and it's unlikely that China will stimulate their economy any further, especially given the inflationary pressures that they had immediately after their own fiscal stimulus back in 2009, 2010. Finally, in Latin America's forecast to grow by, this is collectively in Latin America, particularly Brazil, and if you include Mexico, is expected to grow at about 3% in 2014. And this is partly because in Latin America, they had tightening of their external financial conditions. There was a revaluation of debt and stocks in countries like Brazil, for example. At the same time, this has been partially offset by the fact that they've had currency depreciations, particularly against the dollar. And that's allowed them to sort of offset the tightening of their external financial ability to raise money on international markets. So just very quickly, you can see there, this is the forecast. If you look at the left-hand scale, that's for the US and the advanced economies, and you can see why the IMF is forecasting that much of the world's economic growth is going to be driven by that blue line, that top line, topping out at about 3% in 2014. And as you can see, there's expected to be that dip in Japanese economic growth as the Japanese government backs away from its stimulus program. That's the euro area. You can see growth is pretty insipid there. Spain and Italy are the examples of the periphery economies. The euro area as a whole basically coming out at about that 1% growth that I mentioned earlier. This is developing Asia. You can see there's been a big decline in Indian economic growth. As you know, India faces a number of economic problems, both in terms of inflation, dealing with their fiscal imbalances and so on, and there's China chugging away there at nearly 8% growth. If that's backing off economic growth, I'm sure we'd be happy to have nearly just under 8% growth in the US in 2014. Here's Latin America. Brazil is picking up partly because of exchange rate depreciation. In the case of Mexico, Mexico's likely to rebound if the US economy picks up. Clearly, Mexico is incredibly integrated in with both the US and Canada in the North American free trade area. Let me say a little bit about inflation. No doubt my colleague from the Fed is going to talk about inflation expectations here in the US. But globally, inflation pressures are pretty subdued. Why is that? Well, we still have very large output gaps in the advanced economies. What that means is the potential for production far outweighs actual production. And it's when the output gap closes that you tend to get inflationary pressures in the economy. And we still have pretty large differences between potential production and actual production here in the US and elsewhere in the developed world. If you follow commodity markets, well, a year ago what I was talking about was high food prices, and we were talking about that in 2008. Commodity prices have actually fallen. I think I filled up with gasoline today for less than $3 for the first time in a long time. But this is true broadly of commodities, not just oil prices, but also food commodities and other commodity prices have significantly softened in terms of prices. And part of that's being driven by the fact that demand is softening in many of the emerging economies, including China. China's been not solely responsible for driving up commodity prices, but it's been a big player in driving up those prices, particularly agricultural commodities. So inflation rates then in the major economies, here's a quick forecast for the Dean down here. Inflation below target, 1.5% in the US. We don't officially have an inflation target in the US, but I think, would it be reasonable to argue it's about 2%?
We do.
We do. There, I was corrected by the guy from the Fed. Euro area, about 1.5%. Japan, closing in on 2%. It's not clear to me exactly where the Japanese inflation rate's going, given the nature of their economy. Emerging economies are running much higher rates of inflation at about 5 to 6% forecast. So here's a quick graphic. This is headline inflation, so this would include commodities. You've got that spike in 2008, you've got the follow-up spike in 2011, and you have inflation rates running at about 2% in the advanced economies, just below 4% globally, and up there around 5% in the emerging and developing economies. International trade pretty much reflects, is pretty highly correlated with the fact that we have relatively weak global economic growth. Let me just show you the graphic here. The red line is emerging economy imports, that's the bold line. The dotted line is the industrial production. You can see the emerging economies are running pretty aggressively there on international trade compared to the blue line. The blue lines, which is the advanced economies, and in the middle you have the world there. So that gives you some sense, and you can see what happened. We fell off the cliff there with international trade in 2008 with the global recession, but we picked up actually remarkably quickly, it seems to me. And as a guy who follows trade liberalization issues in the WTO, it's surprising how little protectionist tendencies we've actually observed in the post-financial crisis period. So in terms of this global imbalances, one way to look at this would be to look at the global current accounts. What we're projecting is that these imbalances are projected to decrease. In particular, we expect to observe lower surpluses in the oil exporting countries. But what we really need in terms of global rebalancing is that China has to expand its consumption. Remember, China has very, very low rates of private consumption, very high rates of investment, very high rates of private savings. For an emerging economy, this is sort of unusual, particularly given their high rates of economic growth. And at the same time, we probably need to have more investment in Germany. Remember, Germany is also running, is one of the few countries in the euro area running a trade surplus. At the same time, some of these exchange rate adjustments that have been going on in both surplus economies and deficit economies have actually supported a little bit of rebalancing. But it looks like that the declines in real effective exchange rates haven't been as strong as you would expect because of inflationary pressures in some of these developing and emerging economies. So, seem to be missing a slide there. Okay, so let me talk about the policy challenges and then I'll finish off, Corin. So I've broken these down by these major economies or major economic areas. So let's take the US first of all. I think the big uncertainties are whether and how monetary easing, quantitative easing, monetary policy here in the US is going to be unwound or tapered. And no doubt my colleague from the Fed will have some comments to make about exactly how that's going to be done. And also there's this issue about resolution of both the fiscal policy and also dealing with the debt ceiling and trying to not run down debt to GDP, but how do we get some sort of cap on US debt to GDP. So there's a very strong potential for global spillovers. I think the one thing we really learned from the global financial crisis is how integrated the global economy really is. And so you can think about a number of scenarios here. You could have the US economy growing and monetary policy being tightened up. We may actually have to start raising interest rates. The dollar would start to appreciate. That's potentially a positive spillover effect to the global economy if the dollar appreciates. Of course, it's not necessarily a good thing for the US trade deficit if the dollar appreciates, but necessarily that might be a good thing for the rest of the world. But at the same time, if we have inflationary pressures in the US and the Fed has to start increasing interest rates, you still get that exchange rate effect, but you may get a dampening effect on US demand. We move to the euro area, the fiscal adjustment is going on, is still ongoing, it's still causing a certain amount of pain. And if you follow the IMF forecast, they're still pushing for countries like the UK and other countries that have been implementing fiscal austerity to maybe back off. I think one of the key issues in Europe, last time I was here, I talked about the debt crisis and how the European Central Bank needed to properly act like the lender of last resort, and it's done that. And in fact, it actually hasn't had to go into significant sovereign debt buying as you might have expected. Just signaling that they would do this was credible. But they still have a very weak banking system. It's very fragmented. There's no real euro-wide banking policy or method for bailing out the banking systems. And one of the problems is that you have a high correlation between weak banking systems and countries that had sovereign debt problems. So I think if the EU should do anything, the euro area, it should probably be the European Central Bank should continue to commit to low interest rates and give a clear signal that it will maintain low interest rates until the euro area starts to show more robust economic growth. In Japan, the key policies, as I mentioned earlier, are quantitative easing, fiscal policy, and structural reforms, which are likely to be backed off in the coming year. But if inflation expectations stay very low in Japan, it's probably the case that the Japanese central bank should actually rescale up its quantitative easing. If you buy into this argument that the way to influence inflation expectations and people's attitude to where they invest and whether they borrow and whether they carry on deleveraging their balance sheets has something to do with what you expect about inflation. In the case of China, the real problem with China is that investment is running at 50% of GDP. This is absolutely phenomenal for an emerging economy. It's not clear to me that all this investment is appropriate. I wonder whether China has its own banking crisis waiting to happen. I think there's a lot of non-performing loans from former state-owned enterprises sitting on balance sheets that we don't know about yet, just like we didn't know about the subprime mortgage problem until it was too late. And the issue for China is to rebalance towards a sustainable private consumption-based growth. And this is what the new leadership in China is claiming that it's trying to do. And in another talk that I'm giving at the moment, I'm talking a lot about what's happening to Chinese wages, how they're pushing up. Is China moving to a high-wage, middle-income economy? At the same time, is it switching its exports to more skill-intensive exports? Is that higher value added? Are we observing a change in China in that way? But there are a lot of institutional barriers to truly freeing up wages, in particular the ability or lack of ability of rural workers to move to urban areas and take advantage of the safety net in China, which is, I think, a drag on consumption. Finally, the emerging economies are facing this tighter external financing, but they actually have relatively low negative output gaps. So there's not as bad a capacity constraint in those economies as you might be led to believe. What they need these economies to have is an orderly exchange rate depreciation in many cases, maybe with some capital controls in order to prevent fast outflows of finance, but they also need appropriate fiscal and monetary policy, and there's no one-size-fits-all here. India, for example, has an inflation problem. It needs to get the money supply under control through use of interest rates, and also there probably shouldn't be a fiscal stimulus in India right now. So I'll finish there, and hopefully we'll get some interaction later on. Thanks very much.
All right, well, thank you very much for having me here today. I'm very encouraged to see so many of you out there, especially a lot of young faces. I think that the events over the last 5 years suggest that we don't have all the answers. There are many questions out there. There are many first-order problems out there that need to be solved. And so I'll certainly give a perspective today, but I encourage you to continue studying and figure out some of these problems that we're facing. So I'm tasked with giving the 2014 National Economic Outlook, and predicting the future turns out to actually be kind of difficult. So everything that I will say today, as is typically the case with a Federal Reserve speech, does not necessarily reflect the views of the Federal Reserve Bank of Cleveland or the Federal Reserve System. So if you've ever heard a Federal Reserve official talk, they've given that exact line over and over, and I'll do the same. So in 10 minutes, I'll just try and hit basically the highlights, talk a little bit about where we are today and where we're likely to go next year. So let's just dive into it. So basically the key theme is that we're going in the right direction, but we aren't there yet. Okay, so that'll be pervasive throughout this talk. We're headed in the right direction, but we're not there yet. And so to start off just with the housing market, okay, the housing market is getting better, it's on the mend, but still a long way to go. So if you look at one chart, this chart seems to summarize this situation pretty well. So these are single-family housing starts, okay? Now during the peak, you were producing about 1.8 million new single-family housing starts on an annualized basis. At the nadir, you're producing 400,000, okay? You can kind of see the height of the bubble and the depths of the trough. Now, over the last couple of years, housing starts have been perking up. You know, they've gone from, 400 to 600,000. So, we're definitely moving in the right direction, but far from where we were even before the bubble when the U.S. population was much smaller. Now, some other measures like existing home sales have been rebounding. Home prices are rebounding and recovering. But this chart really shows kind of the bubble and the aftermath of it as well. So the second key point, I think, to raise is just the federal fiscal situation, okay? So you have fiscal drag coming from federal government in multiple forms, and you have a lot of uncertainty coming from the federal government, again, in multiple forms. So this chart shows the contribution from federal spending, federal government spending, to GDP growth each quarter, okay? And so typically what you'd like to see is that when the economy's weak, the federal government should have a counter-cyclical role and it should be boosting growth. And so that was definitely the case in 2008 and 2009. And since the beginning of 2011, federal government spending has been a drag on GDP growth. And so, of course, the sequester is part of this, but there's also this tax component that's not part of this chart. So once you add in federal tax policy, which has been slowing down GDP growth, and federal spending policy, which has been slowing down GDP growth, then you throw on top some of the debt dynamics that we've seen in the last couple of months, you can see that federal government spending has been an impediment to a stronger recovery over the last few years. So obviously, there's some spillovers. You have fiscal uncertainty, that's likely to spill over to consumer spending. You have higher taxes, that's likely to spill over to consumer spending. And so we're certainly seeing tepid consumer spending, generally speaking. So if I kind of break this down, and hopefully some of these colors have gone through, the top line up there is spending on durable goods. So automobiles, computers, electronics, all of those gadgets that we have in our pockets these days. So durable goods consumption rebounded very sharply in the recovery and has been pretty strong throughout the recovery as well. The black line is total consumption. So total consumption has basically three components: durable goods, non-durable goods, and services. So services is about 2/3 of consumption, give or take, and consumption is about 2/3 of GDP, okay? So services is the bottom line on the very right-hand side there, the growth of services. So when services growth is weak, it's hard mathematically to get strong GDP growth. So we're just buying fewer haircuts, basically, is what's going on there. And so this reflects a lot of different factors. It's reflecting higher taxes. It's reflecting weak income growth. But it's something that's somewhat worrisome, and it's somewhat unprecedented. We've seen stronger rebounds in consumer spending. Tepid consumption of services is somewhat problematic. At the same time, though, we have improving economic fundamentals. Okay, and so what do I mean by economic fundamentals? Well, first and foremost, you have a labor market that, again, is far from healed, but is healing. Okay, so the green or greenish line is the unemployment rate, which is perhaps the single most notable indicator of labor market conditions. So in the recession or after the recession, it peaked at 10%. Last Friday's report showed it was down to 7.3%. So headed in the right direction. It's down by a little bit more than half a percentage point year over year. But normally, you would want to see unemployment in the 5 to maybe 6% range. So you still have what's called an unemployment gap, unemployment that's higher than what we would think of as the normal or the natural rate of unemployment. The blue bars there show an alternative measure of labor market health, which is the change in non-farm payrolls, just how many jobs are being created on net each month. So the bottom line there, about a little bit less than 200,000 jobs on average over this past year, which is solid but not necessarily spectacular growth in labor markets. In addition, I should point out, without some charts, that there are other economic fundamentals that are encouraging. As I mentioned earlier, house prices have been rebounding. For most households, the value of their home is their single largest asset, so that helps to boost their net worth. Stock markets are at nominal all-time highs in many cases. So you're seeing some positive fundamentals that should be supporting stronger growth, and hopefully they will support stronger growth eventually as well. So the next topic then is accommodative monetary policy. So under improving economic fundamentals, we do have low nominal interest rates, low interest rates. And in part that's going to reflect generally subdued conditions, but it's also being helped along by monetary policy, accommodative monetary policy at that. And so what is monetary policy right now? Well, monetary policy basically has two components. So the FOMC, the Federal Open Market Committee, its main instrument is this rate called the federal funds rate target. Okay? During normal times, that's what the FOMC moves up and down. So since the end of 2008, the federal funds rate target has been constrained by what's called a zero lower bound on nominal interest rates. Okay? You can't set that negative. Since that time, the federal funds target has been between 0.25%, and it's been there ever since. And so what the FOMC is doing now is talking about forward guidance, what they anticipate doing with the federal funds rate going forward. And the reason why you want to do that is because longer-term interest rates, which matter more for borrowing, are in part determined by the sequence of rates that are going to happen between now and later into the future. Okay? And so by telling markets that you expect rates to be low for a while, you're trying to influence those longer-term rates, which matter more for our purchasing decisions, and you're going to try and tamp them down. So the FOMC has put into place forward guidance, and you could read this, but I could just translate it for you. It basically says that if the unemployment rate's above 6.5% and expected inflation is less than 2.5%, the FOMC is going to keep this 0 to 1/4% target range for the Fed funds rate. And so this ties into the FOMC's dual mandate, okay? So we have a dual mandate from Congress for maximum employment and price stability. So the FOMC has interpreted the price stability mandate in terms of a specific measure of inflation, which I'll come to in a minute here, to be 2% over the medium to longer run. In addition, we interpret maximum employment to be unemployment getting back to that natural rate that I talked about earlier, which is somewhere in the 5 to 6% range. So as you can see, if these conditions are satisfied that I have up here, this unemployment is being too high and inflation is too low, you're not going to move. That's consistent with the dual mandate that the FOMC has. Now, in addition, the FOMC has been doing asset purchases. So given that they've been constrained by the zero rate on nominal interest rates, they've been purchasing longer-term assets in a bid to stimulate the economy by lowering these long-term rates. And specifically, the FOMC has tied its purchase program to the outlook for labor markets. And they want to see substantial improvement in the outlook for labor markets to stop those asset purchases. At the October meeting of the FOMC, for the second straight meeting, the FOMC said that they were going to await more evidence that progress in terms of the recovery will be sustained before adjusting the pace of purchases. And so at this point, the FOMC is purchasing $45 billion per month of longer-term Treasury securities and $40 billion per month of agency mortgage-backed securities. Finally, then, the last piece of the current puzzle is low inflation. All right. So again, the FOMC has a dual mandate, and one leg of that mandate is for inflation for price stability. And the FOMC interprets price stability in terms of a specific index, which is the price index for personal consumption expenditures. Okay, so this is the measure of consumption that fits into GDP. And it's the price index for that measure of consumption. And so that's the blue line up here in this chart. So the FOMC's target is 2% inflation over the medium term. All right, so as you can see from the blue line there, we're just below 1%. So inflation is somewhat below where the FOMC would like it to be. And again, I think that there's a lot of factors at play here. Some are smaller and some are bigger. So, goods inflation is very weak because of a stronger dollar. Services inflation is somewhat tepid just because of the weakness in services consumption I talked about earlier. But basically, the bottom line is that you just have slack in the economy, and slack puts downward pressure on inflation. Now, a lot of times you'll hear about core inflation, which is inflation excluding food and energy prices. And that's just really trying to get to the trend. What is the trend of inflation? Because energy prices fluctuate a lot, food prices fluctuate a lot. So the red line here shows the trend or core PCE inflation measure, and that's been around 1%, so still below that 2% reading that the FOMC would like to see. Now the Cleveland Fed puts out an alternative measure of inflation, which is called the median CPI. So you take the components that are in the consumer price index, and you look for the one that's exactly in the middle, and that's an alternative measure of trend, and that's been closer to that 2%. So there's some concern that inflation's too low, but it really depends kind of on which measure you're looking at to determine how low inflation really is. That's kind of a snapshot of where we are today. So then the question is, where are we going in 2014? So the first point is, picking up the pace of GDP growth. So I'll be the first person to admit that over the last few years, the forecast has always been that the pace of GDP growth would pick up the following year. We're still thinking the same thing, okay? The pace of GDP growth is expected to pick up next year. So 2011, 2012, 2013, GDP growth has been clocking in at about a 2% rate on a Q4 over Q4 basis. That's not very great. So in normal times, people would think we should be growing 2.25%, maybe 2.5%. So if you're only growing 2%, you're not really shrinking the amount of slack that's in the economy very quickly. All right. However, some of these fundamentals that I talked about earlier are improving. And so the hope is that as monetary policy stays very accommodative and helps to support the recovery, some of these federal fiscal policy issues diminish. You get some stability in Europe, maybe a slight turnaround in emerging markets. The housing market regains its footing, the labor market recovery continues. That all of those factors will help to support slightly stronger GDP growth next year. And you might see something in the range of about 3%. But still, not very robust in historical context. So as GDP continues to grow and maybe even picks up the pace, forecasters continue to expect ongoing improvements in labor markets. And so again, we've seen a pretty steady decline in the unemployment rate. There is somewhat of a debate among economists about what's driving this. Is it GDP growth? Is it people leaving the labor force? The bulk of the evidence tends to favor the first one, that it's GDP growth. But there are concerns about people leaving the labor force and what that means, how we interpret unemployment rates. Nevertheless, forecasters think, and I should point out here that I'm using the forecasts that come from the FOMC, but private forecasts are very similar, that unemployment will end this year in about the 7.25% range, so about where it is today. And it'll end next year closer to 6.5% or 6.75%. So you'll continue to see some slow but steady progress in terms of reducing the unemployment rate. And finally then, inflation right now, as I said earlier, is low, but with a gradually improving economy, a gradual decrease in the amount of slack that's out there, we expect that inflation will gradually begin to rise over time. And so again, inflation's right around 1% or so today. By the end of next year, forecasters think it'll be around 1.5%, maybe 1.75% or so. So still somewhat subdued compared with that 2% inflation target that the FOMC has in mind. That concludes my prepared remarks, but hopefully I'll have stimulated some of your questions for later on. Thank you.
Okay, first a little bit of housekeeping. You may remember we started at about 7:30. It's about 8:15 now. We were each supposed to have about 10, 12 minutes. I've been informed that I have 15 seconds to get this out. So I'll try and keep this reasonably short. One of the things I always try to do in a thing like this, a presentation like this, is to kind of give a theme for what I'm going to say. And as I did that this time, I actually came up with two. They're the same thing, but one's kind of a nice way of putting it. The other's maybe not so very nice. The nice one is that if you loved the years 2010, 2011, 2012, and 2013, then 2014 is likely to be your cup of tea because there's not going to be much change. A less kind way of putting it, while imitation may be the sincerest form of flattery, needless repetition is probably the surest path to economic perdition. And that's where I think we're going. Now, what I'm about to do here, this is going to sound a little on the wonkish side, and maybe it is, but if you think about it, we have, over these past few years, as we think about an economic outlook and think about what it seemed like during the course of the year, it would seem, with a heavy emphasis on the word seem, it would seem as though we've shifted very, very quickly to at times being incredibly optimistic and then turning around and just about as quickly being very pessimistic. And I think we need to kind of back away here a little bit and think about this and wonder whether or not things are really changing that quickly, or should our outlook be changing that quickly. A couple of examples here. Approximately 4 years ago, I was here. This was in January of 2010. I did my song and dance that particular evening, and much to my surprise, I found out a few months later that I was tagged with the title Dr. Doom. I wasn't quite as optimistic as some others. I thought that this idea back in 2010 that we were about to have a recovery summer with this big explosion of economic growth given the fiscal stimulus of 2009, to me it seemed very unlikely. As we moved through the year, by the time we actually got to that supposed recovery summer 2010, everybody was starting to talk about recession, except me. I continued to say relatively modest growth, not much is going to happen here. By the end of the year, everybody, myself included, was saying, nah, probably just mediocre growth. The point is, without moving an inch, I went from pessimist to optimist to middle of the road. It was really quite amazing. As another example, and this actually is leading someplace, earlier this year, since I'm supposed to be the guy talking about local activity, in the state of Ohio, earlier this year, we got, back in May of this year, the payroll employment report, and it indicated that the state of Ohio in that single month of May gained better than 30,000 jobs. 30,000 jobs, which was a huge percentage of the total that month for the entire country, and it was the best in the nation. 1 month later, in June, we lost about 8,500 jobs, and we were the second slowest in the nation. We had the second biggest decline in the entire country. Here's where I think we need to kind of back away a little bit and really think about this. Do we really believe that people, and just as surely, do we believe that businesses changed with that degree of rapidity, or is there something fundamentally wrong here? And that's basically the position I would have. Within the course of a year, I think we are finding some problems. We are now 4.5 years approximately into an economic recovery in this nation, and it has been an extremely anemic economic growth at that, an extremely anemic economic recovery. I think what we're finding here is that in that kind of very slow growth environment, people and businesses are having to adjust significantly in ways they never had to in the past. They are having to adjust how they do business. So let's think about it, and I had an example just here recently as I was looking at things. Retailing. Retailing is one of those things that I've been watching for years, given the kinds of work that I did in the past. And retailing in the past few years has become quite different. The nature of retail sales has changed over time. 2 years ago, in 2011, you all may not recall, but I recall it vividly, almost immediately after Halloween was over, the Christmas ads began, and they were pushing us hard to get out into those stores and spend. Last year, similar kind of thing, but it started way earlier. It started in October. In October, Christmas decorations up, and everybody was told to get out and spend. We were seeing retailers who were announcing very early on what their layaway plans were going to be. We've seen that this year. This year, the same thing is happening, except it's backed up even a little bit more into very, very late September. The point here is that I think in this case, what retailers and other businesses are doing it in their particular lines of activity, what businesses are having to do is basically in this slow growth kind of environment, to the degree they can, they are having to accelerate us in terms of our purchases. They're trying to get us to more quickly, in the case of retailing, locking in our sales relatively early, given that most of us have a budget to live with. And so what I think we're starting to see, and it's becoming, I believe, more and more and more pervasive, is that one of those things we depend heavily upon in the economics profession, this wonkish thing called a seasonal adjustment process of economic data, is fundamentally breaking down. And it is giving us horrible, horrible indications as to within the course of a year where things seem to be progressing. In the latest employment report, for example, that came out just last week, there was a very, very significantly sizable increase, better than 44,000 retail employees. Why? Because as they are backing up their desire to get us into their stores, they are hiring their employees more quickly. The thing is, once we get into late November and early December, the numbers there are going to look absolutely horrible. It's been a pattern that's been unfolding for these past few years, and the unfortunate thing is this seasonal adjustment process is working poorly, and so it is giving our nation's policymakers incredibly bad signals about how the economy's performing, where literally 1 month we seem to be doing marvelously, the next month we seem to be doing horribly, and so policymakers, no offense, particularly at the Federal Reserve, are very quickly giving out these indications. Maybe we need to be more accommodating, maybe we need to keep quantitative easing in place a little longer. The next month they shift back, and all of this is creating this tremendous uncertainty within policy-making circles and within the business community. Or even take that thing that I talked about with regard to the state of Ohio. Now, this is a real oversimplification. In May of this year, we saw a huge increase. In June of this year, we saw a big decrease. It was certainly not the entire thing, but think about it. What may have caused something like that? Academic institutions. This is the first year where the state universities here in the state of Ohio are on a semester basis. They went from quarters to semesters. In the past, those people coming into the workforce, businesses absorbing them, would have first be seen in June. This year, it happened in May. And so we get this huge increase, seemingly, in May. We get a depressed number in June. I think what's likely to continue happening is we're going to continue seeing within, not across years, but within the course of a year, we're going to continue seeing these bad signals being sent out. Policymakers are going to continue to misinterpret them, and we're going to see continuing almost indefinitely into the future this kind of uncertainty showing up in business decision making. They are not going to increase their hiring in any significant way moving into the future. They are not going to be investing heavily in plant and equipment. They will do as necessary what they need to keep productivity gains relatively large, but that's going to be something that's going to be relatively modest. So as we move into the future, and I see my numbers here on time are ticking away. I've used up my entire 15 seconds. I think what we're likely to see in the state of Ohio is that we will see in 2014 a few tenths of a percentage point increase in employment levels. Exactly what that's going to be, I'm not going to say right now. Somebody's going to nail me to the wall next year, the year after. Plus, we've had 2 months now where we've had no data because of the government shutdown. but I think it's going to be just a very few tenths of a percentage point increase in the state of Ohio, which is not terrible. In that, keep in mind, here in the state of Ohio, when we record a population growth rate of 1 or, oh my God, 0.2 of 1 percentage point, we think we're doing marvelously. In that kind of a very slow growth population environment, those relatively few tenths of a percentage point increase in employment keeps the unemployment rate reasonably low. In the greater central Ohio area, we have over the past few years, and will probably continue to see moving into the future, a better performance. My guess is, and at this point again just a guess, probably payroll employment growth somewhere in the range of 1 to 1.5%. It'll keep our unemployment rate very comfortably below the national level. But in all of this, I think the thing that we need to keep in mind here is that even though we economists just positively fixate on every economic number that comes out of Washington and then trickles down here into the state of Ohio and into the local area, it's probably best to start ignoring those month-to-month gyrations, which can be extremely sizable, and take a somewhat longer-term viewpoint. If we get lucky, maybe someday policymakers will follow, and at that point in time, maybe some real honest-to-goodness progress can be made on economic growth and employment growth. But until that recognition is made, I don't think things are going to change very much. There, I kept it in my 12-minute limit. Thank you.
Actually, we can use these. Thank you, our panelists. Very, very informative presentations. I wanted to ask you whether you had any questions for each other. Yeah?
Actually, I have a question for Edward here. If I understand the economics of quantitative easing, it's this idea of, I forget which economists use this language, a credible pre-commitment to be irresponsible, right? So the
Forward guidance, or?
Yeah. So the idea is, so I wonder whether if you have a target rate of inflation of 2%, right, and people know about this, that's their expectation. Is it not the case that once you hit the 2% rate, that you'll switch off the taps and you won't have been irresponsible because you'll have hit your target? So what I'm trying to get at is, how do you know that you've changed people's inflation expectations, and how do you know when to switch off the tap? Does that make? I don't know if that makes any sense. I mean, if you buy into this idea of time-consistent behavior, right? We're trying to get people to change their expectations.
So first off, so this relates to the federal funds rate policy and the forward guidance that the FOMC has been giving. So if you look historically speaking, what the FOMC would have done would have been probably to start raising interest rates now or in the past. And the idea behind the forward guidance that they've given is to essentially tie the hands of policymakers to prevent them from acting the way that they have in the past. And so that goes to this discretion versus commitment question. So discretion would mean that ahead of time you might say you're going to do one thing, and then when the time comes, you're actually going to do something different. So the funds rate guidance is actually a form of commitment, and it's trying to get better outcomes by letting unemployment come down more than you typically would have previously. So quantitative easing, or large-scale asset purchases as they're called, are something different. The purpose of those is more to get some momentum going on in the economy. And that's why they're set up with substantial improvement in labor markets as kind of the goal there. But the forward guidance is really to constrain in a soft way monetary policy beyond what it historically would have done. And that does change expectations then.
Yes, I'd love to say something. and that is we seem to have gotten stuck in this belief that somehow the Federal Reserve is an economic savior, that somehow they have the ability to fine-tune the economy, whether it's through the normal process, open market operations, and manipulating short-term rates like the federal funds rate, whether it's the quantitative easing thing to try and help bring down long-term interest rates. I think we're fooling ourselves at some point to think that these kinds of things are going to have any meaningful impact. You know, the most basic economic theory tells you that as you slide down along a demand curve, it's going to become more and more inelastic, which is to say the impact of that price change, that interest rate change, the price of money, is going to become less and less impactful. There comes a point when you just have to back away and take this longer-term viewpoint. Don't believe that you're going to manipulate a nearly $17 trillion economy into doing what you want it to by playing with interest rates, whether they happen to be short-term or long-term. At some point, simply get back to some normal level of monetary accommodation and then let the marketplace take over. It's going to be painful potentially at first, but it can't be a whole heck of a lot worse than what we've been seeing over these past few years.
Questions or response or?
Sure. So what matters is the shock that you were hit with. And so in a case like today, where you have a large debt overhang, and you have banks that aren't necessarily lending as much as they might have in the past because they've tightened up standards, then that intuition actually doesn't necessarily hold, because as the economy improves, and lending standards ease back towards more normal levels, demand could actually be stimulated even at the same interest rate. So monetary policy could potentially, in theory, become even more powerful even if you just keep interest rates at the same level. So I guess the bottom line there is that you need to take into consideration what's going on in the economy. You can't just say that a low level of interest rates is going to have less effect over time. I don't know that there's any empirical evidence to support that. And the counterfactual is, you could look at Japan and you could look at places where they have kind of pulled back on accommodation too quickly to get towards that more normal rate of interest or level of interest rates. And that can short-circuit the economy, can short-circuit the recovery. And then interest rates actually stay low because they're reflecting weak economic fundamentals and conditions. So there's two factors that are pushing rates down. One is the general level of activity, and the other one is monetary policy.
And yet, of course, as we think about this, if you look at the monetary accommodation that we've seen here in the United States, as I recall some of the latest numbers, we are swimming in liquidity right now. I think excess reserves are somewhere around $2.5 trillion. Monetary accommodation here is not much of an issue. As well, keep in mind, while low interest rates may help some, they are an absolute burden to others. The one that they are just absolutely killing and have been for years. And these are individuals who could just as surely have spent and stimulated an economy, are seniors who have seen the level of interest rates that they're getting on their various investments, their various savings vehicles, dipping to virtually nothing. It makes pension funds much more liable for problems in a low interest rate environment where they simply cannot meet their obligations on an extended period of time. So there is a lot to consider here, and I don't think the Federal Reserve is looking at everything the way it should be.
We could keep going.
If you would,
I'm happy to respond to that. So there are costs and benefits to everything. Econ 101 is all about cost. The counterfactual is if not really your congressionally mandated objectives, and you don't have much different interest rates to basically transfer wealth to the savers and the seniors that you referred to.
However, wouldn't it be much more comforting? Maybe it's just me as this market-driven economist. Wouldn't it be so much more comforting to know that it is markets, if indeed that were true, which I'm not sure it would be, that it's markets producing not those lower interest rates, not this constant drumbeat of manipulation by the Federal Reserve?
Can I get a word in edgeways here? I'm actually,
And then I'll turn it to the
Sure.
audience for some questions.
I guess the question I mean, I'm actually going to stand up for my colleague from the Fed here. I think, at least until the financial collapse, I think it was sort of well understood that we did understand how monetary policy worked. I mean, we'd moved from targeting monetary aggregates in the 1970s and the 1980s to targeting the rate of inflation through this instrument of the official rate. And, you know, I read a lot of papers that talk about the science of monetary policy, which I find sort of convincing that we have a pretty good understanding of that connection, at least in a relatively smooth part of the business cycle. So I guess the question I'm sort of interested in asking is, on the side of fiscal policy, it's sort of alchemy, it seems to me. And I wonder whether, and I throw this out to the audience, I wonder whether, like I think Sweden is experimenting with this and some other countries, are having a constitutional amendment whereby, think about monetary policy is set by the independent central bank and is not supposed to be subject to political influence or manipulation. And I think that was one of the great achievements of the Tony Blair government, if you can count that as an achievement, that he did separate out the Bank of England from the Chancellor of the Exchequer. No longer was sort of setting interest rates. It was now being set by an independent central bank and a money committee. That we go down this track with fiscal policy, that we sort of target, we set up an institution that by constitutional fiat sets a target rate of the budget deficit as a proportion of GDP, and if you go above that target, taxes kick in and spending starts to fall, or if you go the other way, taxes fall and spending rises, and that what you do is constitutionally determine the size of the pie and just let congressmen and people in the Senate decide on how to share out the pie. They no longer decide the size of the pie. So you have targeted fiscal policy in that sense, like we do monetary policy, because I buy into the idea that we do know how the money supply affects inflation and economic activity. No response?
No, I think that that's consistent with academic work that's been done in this area. So at the Kansas City Fed Symposium in Jackson Hole, Eric Leeper had a paper, Fiscal Alchemy, just a few years back. Monetary policy, science, and fiscal alchemy. Yeah. So, even if our knowledge of monetary policy is imperfect, it seems to be much further developed than our knowledge of fiscal policy, for sure.
And yet,
Can I?
oh, okay.
I would like to ask the audience whether you have any questions. And if you do have questions, please raise your arm so we can actually give you a microphone for our internet audience. That's a really good paper. I wondered if you read it as
Hi. Sorry. I don't want to use like fix. I don't think fix is the right word, but thinking like in an international scope with China, where they're dealing with their current currency thing. Some say it's undervalued, and as they're trying to go forward, turn it into a global currency. How do you think that will affect China's output in the next couple of years?
Well, my view is you need to look at real exchange rates, not nominal exchange rates. And I mentioned earlier that Chinese wages have been going up quite significantly over the past 5 to 10 years. If you look at the history of China since its reforms, wages look like this up till the 1990s, and they pick up. So if you look at China's been allowing its nominal exchange rate now to appreciate since, 2004? Maybe a little bit earlier than that, when it was unpegged from not completely unpegged from a basket of currencies, but it was loosely unpegged. But I think if you look at China's real exchange rate, it's appreciating much faster. So I think some of China's, if you like, artificial competitiveness that they maybe achieve through keeping down the renminbi against the dollar and other currencies has been partially mitigated by domestic inflationary effects. Having said that, I'm not entirely convinced that even if you believe that the Chinese currency has been undervalued, and there's a huge debate about how much it's undervalued, anything from 10% to 30%, I think the structural changes that occurred in the global economy through the unbundling of production in developed countries and the outsourcing of assembly from countries like Japan, Korea, and so on to China, this would have happened anyway. So I think China's, if their currency has been undervalued, and I'm not entirely convinced that it has been that much undervalued, that it would have made a huge amount of difference. There's estimates that, in fact, the US trade deficit, for example, with China, wouldn't have been significantly smaller if China hadn't supposedly manipulated its exchange rate. Are we going to switch from the dollar being the world's vehicle currency? I don't think so. We talked about the euro a few years ago becoming an alternative to the dollar. I don't see that happening in the near future. It's still not completely convertible, and until China eases up its capital controls at the border, it's not clear to me that the Chinese currency would be floating completely freely on global markets. Many economists who think about and work on China also argue it's actually in China's interest to start letting its currency appreciate properly, because this would be part of their global rebalancing. But that's another story altogether. So that's my quick answer to that question.
This isn't so much a question, it's more a friendly amendment to Jim's comments. I've noticed the wacky seasonal adjustment month to month over the last year or two, but I think that's kind of a smaller problem than the much larger problem of the increasing uncertainty surrounding the trend, the underlying trend in particularly metro level and to a certain extent state level employment growth. I started looking at all this about 1999, and it seemed that the March adjustments would come out and they'd be a few thousand up, a few thousand down. But now we're getting adjustments that double our rate of growth or cut it in half. And so I think there's a real problem there for people who are trying to assess workforce needs, to assess needs for retailing, and that sort of thing. I think there's been, for some reason that I don't know, a breakdown in the underlying models.
Thank you.
A question for Ed. I won't bore people with the inside baseball talk of what's the meaning of the unemployment rate, but what we see is, if we look at the unemployment rate clearly from the depths of the recession until today, there's been a lot of recovery in terms of the unemployment rate, from roughly 10% down to 7.3%. But there's another measure, which is what percentage of the population has a job. And those two measures are, unemployment and employment to population, are not one and the same, because if you give up looking, you're no longer considered unemployment. And that employment to population rate fell from roughly 63% to about 58% during the depths of the recession, and now it's still at about 58%. So with all that at background, what I'm really asking, should we feel sanguine that we're approaching a point where we can take our foot off the accelerator in terms of trying to stimulate the economy?
So though I'm going to interpret your question as basically asking which is the better measure of the labor market.
As I tell my students, use a dashboard, use more than one measure, but
Right.
looking at the whole picture, how do you feel?
Right. Well, so employment to population, in the past there has definitely been a cyclical rebound in that, and now you have this basically a demographic tsunami going on. And so how do you kind of account for that, and what does that mean? So the demographic tsunami is the baby boom generation who's retiring, okay? And as they leave the workforce, that's really changing labor force participation, and it's changing the fundamental nature of this E-pop ratio, as it's called. And so because of that, it's really tough to say whether E-pop is telling us the right thing or whether we should just focus on the unemployment rate because that's the single best indicator of the labor market, or whether we should be focusing more on these flows in and out of the labor market, which of course are not going to be picked up in the unemployment rate. And the evidence so far seems to suggest that the unemployment rate's doing a pretty good job. There's definitely unavoidably been some people who have left the labor market and they're discouraged and they'd come back if there were jobs available. But the weight of the evidence suggests that more and more of the change in labor force participation is structural, meaning that it's demographically driven, and there's little evidence that it's very cyclical. So that's something to be on the lookout for, but it again kind of favors the unemployment rate as maybe being a little bit better in terms of cyclical pressures than like E-pop would be.
However, one thing to keep in mind here, if you look at the population of the United States and kind of the three major demographic segments that we're dealing with right now, we have the baby boomers, those born between 1946 and 1964, who in fact are starting to drop out, a very normal thing to do at this point. We have Gen X, it is this sandwich generation that, depending upon your definitions here, started in 65 into somewhere in the early 1980s, and then that's followed up by Gen Y, or the millennials as they're sometimes called. The thing to realize here is these two ends, the baby boomers and the Gen Yers, the millennials, in terms of numbers are remarkably similar. And so you have to keep in mind as we're looking at this kind of a measure, yes, we have fall off on this end, but we also have entry on the other end. And given that these two demographic segments in terms of size are very, very similar, it may indicate that we do have some problems here in terms of exactly what this means to the unemployment rate and whether or not we're improving as much as what it might suggest. So it's not just a matter of looking at the baby boom, you have to look at the other end, which is coming in, and Gen Y is starting to come in relatively large numbers.
This is a question for Dr. Sheldon. In recent years, I've been hearing about companies, U.S. companies, moving production away or manufacturing away from China into other countries. What other countries are the beneficiaries of this in which production is increasing?
Sorry, I didn't quite hear your question. Could you just repeat it? Sorry.
Sorry. In recent years, I've been hearing about China or about U.S. companies moving manufacturing away from China and going to other countries to produce their goods. If this is true, what other countries are receiving this production?
Well, we're seeing two things I think are going. One is we're seeing a shift to lower wage countries in Asia. I think Vietnam is a good example. But a few months ago in The Economist, there was a very good special issue on, they were calling it resourcing, which was companies outside of the US, either American subsidiaries or companies based in Asia themselves, were starting to locate production here in the US. And I believe Lenovo is a particularly good example. Lenovo was the Chinese company that took over the IBM ThinkPad. And you think of IBM as being a canonical example of a company that outsourced the assembly of its computers to China because of low wages and because of this unbundling of the production process. But in fact, Lenovo is now is a Chinese company, and now they've located a plant here in the US. So I guess what was this huge phase of offshoring that occurred in the late 80s through the 90s through into the early 2000s is we're seeing a shift away. Think about the way outsourcing worked. It was originally Japanese companies shifting to countries like Taiwan and Korea. Their wages went up. They shifted further out within Southeast Asia to China, and now they're picking countries like Taiwan. There's a little bit of a debate about how you should define these things. I tend to talk about moving production activities offshore as offshoring, as distinct from outsourcing, which I think of as the use of modern electronic communication methods to take back office services or looking at x-rays and getting somebody in Bangalore to look at them. It turns out that India is no longer such an attractive market to outsource to, because if you look at if you measure it simply in terms of a simple index, Bob, of the price of computer programmers, it's turned out that the price of computer programmers has gone down in the US with the recession, and the price of computer programmers has gone up in India. So you're getting the classic sort of not factor price, you're getting factor price equalization through outsourcing, which is sort of an interesting economic phenomenon to observe. And the other thing is most of the jobs that could have been outsourced from the US through electronic methods have been. And any more jobs that could have been outsourced have actually disappeared because of the recession. And so I think we are seeing a structural change in where US companies are offshoring or outsourcing. We're seeing resourcing, that's coming back to the US. And we're seeing other countries in Southeast Asia with lower wage structures now being the end result of further investment. I'm not sure we're seeing what we saw in the 80s, which was a sort of competitive race to the bottom in tariff cutting that went on in Southeast Asia, because now we're seeing this sort of noodle bowl syndrome happening in Southeast Asia, where once China joined the WTO, suddenly everybody formed these free trade, regional trade agreements that are causing this nasty mess of rules of origin. So anyway, that's a long answer to a short question.
The other part I think we have to consider here to understand fully the dynamics of what may be happening is we speak perhaps a bit too much in terms of labor and its need within the production process. We've seen it here in the United States. We've seen it in the state of Ohio. At times when manufacturing employment is falling steeply, we still continue to see output going up. So that I think in part what we may be seeing, certainly what we're seeing it here in the US, and we may see it overseas as well, is that these shifts in operations are not necessarily heavily labor related. Realize technology is highly mobile compared to skilled labor. And so you can move from one country to another, and that doesn't mean that huge amounts of labor are going to be gained or lost.
I think we might have time for one more question.
When I took economics classes in college a long time ago, I remember two things. One was there was a lot of graphs involved. And the second one was that the natural world, or the services that the natural world provides, were considered an externality to economics. A graph that I think has made the biggest impression on me is the hockey stick that shows the amount of CO2 that's going into the atmosphere these days compared to a really long period of time. And so my question to you is, perhaps not an economics or an economic outlook, but an economics outlook. taking into consideration climate change or global warming, what impact does that have to the way we are looking at economics these days?
I'm sorry. Could you, I didn't catch quite the very end of your question.
It seems to me that there's evidence, mounting evidence, that the natural world and the services that provide are not an externality to economics. They're limits that we have to operate within. And so my question is, what impact does the idea of global warming have on current economic thinking now?
I'm willing to take a shot, partly because in another life I work on the intersection between trade and environmental policy. Depends, I mean, if I think about it as a policy question, because that's what I do, is think about policy issues, I think economists have done a considerable amount of thinking in the environmental economics and resource economics literature about how to address what you called, I think you used the language externality. And historically, economists have typically had to deal with what we call local public bads. So this would be, a local smokestack problem, and so we think about what would be the optimal way to deal with that, and the argument is typically we target a tax. I mean, this was Pigue's great contribution to welfare economics. Or we think about how we try to deal with sulfur dioxide emissions here in the US. We had a cap and trade system, and it worked quite effectively in reducing sulfur emissions. Now, with climate policy, of course, we have a global public bad. It's something that affects everybody globally. It also clearly has these intergenerational effects that we have to think about. And so, economists have thought a lot about how we're going to address climate change. And again, we typically come up with the typical policy solutions, which is some kind of tax on emissions. And we think about how to value the costs and benefits of that policy by what choice of discount rate we make about future generations and cross-cutting across poor people versus rich people in the current generation. So I think most of our focus in economics has been on what policies could we use to mitigate climate change. But I think we're also starting to think about, well, what if we can't mitigate climate change? As you know, we still don't have a global agreement on emissions, and I don't have a great deal of hope that we're going to get one. And that's where my work comes in, because we observe a lot of countries unilaterally imposing climate policy, like Australia, and other countries not, and you get this free riding problem, and then you get these problems at the border, all the debate about competitiveness and leakage and so on. And so that simply reinforces my view that we have to have a global agreement on carbon emissions. But more and more we're talking about adaptation. And I guess adaptation is about, how are we going to deal with higher temperatures? How are we going to deal with more severe weather? How are we going to deal with different length growing seasons? How are we going to deal with food insecurity if you live in subtropical or equatorial conditions as opposed to northern European conditions? I mean, I think about myself coming from Europe. We now have a 2-week longer growing season. We already have ridiculous agricultural policy in Europe, and now we're going to produce even more. And because of climate change, yet, when we're not thinking about how to actually adapt to those changes. And I'm not sure as an economist I can answer those questions, whereas dealing with mitigation, I think we have a pretty strong toolbox for dealing with that. Now, if you're saying we should go to local foods or organic foods or sustainable production, I'm a trade guy, so I have a really hard time with the concept of local foods. I grew up eating local foods when I was a kid. My dad grew vegetables, and I tell you, carrots and kale gets pretty bloody boring in the winter. And there's a reason why we like eating grapes from Chile. But I think I know where you're coming from, but I'm not sure I have I don't think economists think very much outside of their typical toolbox, which is we have a market failure, it's long term, it could be local or global, and what kind of instruments do we use to target those those problems? And one of the things I'm hearing in the climate policy debate is the rush to think about policies. We often, I tend to have a litmus test, a standard rule, which is my job as an economist is we don't live in a first best world. By that I mean we can't use the right instrument. So my job is to stop politicians. My job is to ensure politicians use the least worst instrument for resolving a market failure. And that's kind of where I think we are on climate policy in terms of economic policy. So I'm not sure, I think I know where you're coming from, but I think you might be asking a slightly deeper question. Do we need green accounting? Do we all need to, local foods is the one I keep hearing from my agricultural economics colleagues. So, and I'm not going to, Doug Southgate's gone. I was hoping he would be here. He would say something really rude about local foods on my behalf. Just to throw you back an interesting example, it still makes more sense for the British to import lamb from New Zealand than it does to produce lamb in Britain. The carbon footprint is lower. So think about that.
Well, we heard today that China's growth of 7% is not that outstanding. We heard that we are moving in the right direction, but we are not quite done yet. And I've heard that although I don't drink tea, 2014 will be my cup of tea. Thank you very much. I thank the panelists, and we'll see you next year.